Today I want to discuss with you one of the core tenets of the Taroso investment philosophy, and that's understanding that every investment idea begins with a qualitative premise that we check with a quantitative data or risk metrics. So let's start with a premise that we promoted from the beginning of this year, which is that the market is likely to be quite volatile without federal stimulus to prop up the fundamentals and valuation. And with that, we have seen quite a bit of volatility. In January and February, we had drops of 8 to 10%. We've seen a single day drop from Brexit of 3 to 5%. But at the end of the day, the market's up about 7%. So what do we see going forward? We expect more volatility. The valuations are stretched, the earnings are stretched, the artificial stimulus is gone. So how do you prepare for it is really the main question. Well, one thing that we've seen many investors in the ETF marketplace do is move towards minimum volatility products. USMV from iShares is a great example. It's up about 13% this year. It's brought in about $7 billion. It's now a $15 billion ETF, which means it's doubled in size. But how do they make their investment decisions? Well, it's quite simple. It's 100% quantitative. They look at essentially what was low volatility last year, and they buy it this year expecting it to also be low volatility. The net result is a PE that's higher than growth ETFs, massive concentrations, and in our opinion, likely bubbles. We believe there's ways to take a qualitative premise of low volatility and prove it out again with quantitative metrics. And I'm going to share with you two ideas that we've had in our portfolios for quite some time and how they're doing and why we think they're a better choice than over USMV. So the first is RWK. It's a mid-cap ETF from Oppenheimer. It focuses on top-line revenue. It reweights the traditional mid-cap indexes on revenue. By doing that, we believe it overweights the companies likely to be acquired or companies that have the ability for margin expansion. That to us makes a lot of sense, but then we got to check the metrics. So first off, the price to sales is 2/3 less than the market cap weighted version. The price to book is almost half that of the market cap weighted version. The PE is 25% less than the market cap weighted version. And the returns this year, 12%. We feel very good about that and we think it can continue. Another example is KNOW. KNOW is an ETF from Direction that we've owned in our Global Alpha portfolio. And it's focused on what do insiders know, that hence the ticker KNOW. But more importantly, before they look at what the insiders are buying, they first take the S&P 1500 and screen out all the companies with questionable accounting, looking to get rid of those Bear Stearns and Fannie Mae's and Lehman Brothers and create a characteristic that's likely to protect the portfolio. Then the alpha is generated through finding the ones where insiders are buying. The PE is substantially lower than the growth ETFs and the overall market, and all the fundamentals check out. So those are two examples of qualitative theses on how to get low volatility returns with quantitative data to back them up. Unlike USMV, where it's completely based on how did it do last year, hope it does that way this year. Hope that helps, and thank you for your time.